So first up, we have a presentation from Po Valley Energy with the ticker code PVE. Po Valley is a European gas producer with a portfolio of natural gas fields in northern Italy, and is currently producing initial flows of gas to meet Italy's domestic energy challenges. Kevin, I'll hand over to you.
Thanks very much. It's great to be here. We find ourselves, as you mentioned, at the right place at the right time, and we've become a bit of an overnight success that's taken us 20 years, as the usual story. We're an energy producer in Europe at a time when Europe is desperately in need of energy security. We've only got a few minutes, so I'm going to whip through some of these presentation slides, but they'll be available on our website. That's our normal disclosure and disclaimer. If we can go forward, please. We've got 5 or so key licenses in Italy. I'm going to be focusing on the Selva Malvezzi production concession today. That's where some of the exciting work has been done just recently. We've got a number of other fields, and happy to talk about those to anyone that is interested, perhaps during the Q&A or at any other time. Thank you. If we can, we've got the main highlights that we're strategically very, very well positioned. We've got a highly credible Italian team that we've built up over the last 20 years, and we're producing and revenue generating. We've got quite a bit of material near-term upside. That's going to be quite an interesting phenomena for us over the next year or two. Thank you. I want to focus, though, particularly, as I mentioned, on the production. We came into production just over 12 months ago on the 4th of July last year, after quite a period of time. This is a very busy slide, but I have put it up. This is because we get this every week as an analysis of what's going on at our board level. If you look across to the left-hand side, we have the Po del Mare well. The cost of drilling the well was around about 3.7 million euros. We own 63% of this, so I usually do the conversion to Australian dollars from euros. It's about the same. So if it's costing 3.7 million euros and we have to pay 63% of that, then what happens is it becomes around about $3.7 million roundabout. The well was drilled in 2017. We had a long hiatus where we didn't have the capacity to raise capital. There was also some issues in relation to getting approvals, environmental approvals, and getting through the system and so forth. I took over 2 to 3 years ago as chairman, and what we went into was immediately getting those approvals, getting the construction of a pipeline, building a pipeline to the national grid, and then building the surface installation plant. The cost of that was about 4.4 million euros, which our copy was around about 63% of that, so about 4.4 million Australian dollars. Once we completed that installation plant on time and on budget, we then were able to start production. If you look at the top right-hand side, we've got the production graph there. We spent the first 6 months of production testing different levels, testing for any sand ingress or water ingress, really setting what we were able to set as the long-term production of the well. And by Christmas time last year, we settled on about 80,000 standard cubic meters per day. We've been testing periodically with slickline, and we found that it's come up perfect. It's humming along like a well operating Swiss watch, and that whole situation has continued on, and that is now producing the cash flow that we are able to use for some of the lookalike wells that we have. The other charts there are showing the revenues that we receive. Gas prices in Europe have been up and down quite a bit. At the moment, they're chugging along at around about 40 euro cents per standard cubic meter. Now, if we're producing 80,000 standard cubic meters per day and the gas price is 40 euro cents, then that produces around about €1 million per month of revenue. our 63% share gives us around about $1 million per month. If the gas price has gone, if it goes down to 30 euro cents and we're only producing the same, maybe let's say 2,000 standard cubic meters per month, that's going to give us, $6, $7, $8 million per annum in revenue. If we can produce at 40 euro cents and 80,000 standard cubic meters per day, that's going to give us around about $1 million per month. So those are the numbers that we're managing. The cost of production is around about 800,000 euros per annum. And so we've then got quite a very healthy revenue. Our cash balance at the moment is well over $5 million. And we are doing some seismic. We're preparing for seismic to really test the capacity here. We're running at about 20% below capacity, just so we can extend the length and the life of this well. And it's performing extraordinarily well. So we're quite excited about it. We're going to be using the cash flow to then develop some of the lookalike wells. If we can move on to the next slide. Thank you. We have in the middle of this little chart here, little map, is the green Pot de Mer well that I've been talking about. But we also have a number of other lookalike prospects. We've got several of these prospects which we intend to drill over the next couple of years. And once we've done the seismic and we've really scoped out the entire concession with 3D seismic, we've been using a lot of 2D seismic that we've been able to purchase from E&I because they drilled in this area. It was one of their most successful areas in northern Italy. And there's a number of anticlines that have been remaining. We've been able to drill them. And literally in the Pot de Mer concession, we've got over 8 billion cubic feet that is in 2P reserves, as well as an additional 18 or so billion cubic feet in 3P reserves. We want to try to ensure that we can actually make this concession last as long as possible. We've got north and south just to the side there, and they're also within a kilometre or two of the national grid. We've got the East Selva prospect and the Ricardina prospect, which we intend to drill over the next couple of years. And we feel that this is going to really be a game changer for us. So we've been very excited being able to develop each of these fields in this concession. Thank you. So in 2023, we got the award of the gas sales agreement, and we were able to get that secured. We got first gas production. We then did a lot of the geology and geoscience work programs. This year, we've been maintaining that steady production at around about 80,000 standard cubic meters per day. We've then done the advanced work programs on Selva North, Selva South, Selva East, and Ricardina. We've got the 3D seismic campaign that's in progress at the moment. And then we've got the environmental studies, the drilling program, planning applications that we need to go through. We've got quite a good team in Italy that's got a tremendous relationship with the ministry and being able to progress those quite rapidly, particularly now that the government is very, very focused on energy security. So we've seen the ministry has really been very, very supportive of developing the assets here, as opposed to back in the last decade or so, where they were moving a lot of their production offshore, particularly to Russia. And of course, with the invasion of Ukraine, they've realized the folly of their ways, and they're really trying to ramp up domestic production. Thank you. So that's where we're at. We've got the silver production, which is providing strong cash flows. We've got a very solid growth portfolio with development, exploration upside, and potential to support our future growth. We've got some tremendous opportunities for exploration partnership across the assets. We've got a number of large players in Europe approaching us now and talking to us about how they can develop and work with us to develop these assets and their portfolios. We've got revenue from PM1, Pot de Mer 1, which is providing these opportunities. We've got tremendously positive tailwinds. The market opportunities, the market conditions are the best they've ever been. And then we've got an on-the-ground team, which we've had working with us for a number of years. They've got a lot of experience across the team. So we're very well placed to take things forward. So I'm happy to take some questions if we can leave it there. We've got some follow-up in relation to, there's a few appendixes that we've got in our pack there. So please feel free to check that back on our website. Thanks, Jane.
Wonderful. Kevin, thanks for the great presentation. We've got a few questions, so let me jump into them now. So government cooperation in Europe is critical for developing new mining assets, including gas. So can you talk about how the current government is supporting Po Valley's commercialization strategy?
Sure. Thanks, Jane. Well, you're absolutely right. In Europe, if you have a government that is trying to restrict your operations, you're in big trouble. But I think that all changed when Russia invaded Ukraine. The Europeans have looked at natural gas, as an energy transition fuel. It's been able to reduce its emissions dramatically by moving off coal and oil to gas as a transition to other types of energy. So that's been very much a tailwind for us. We've had the working relationship with the ministry, which has been very good. When the previous government was replaced by Mario Draghi back in about 21 or 22, that was a bit of a game changer. We've now got the Maloney government, which is incredibly supportive. But no matter what government is going to be in power, the fact remains that Italy and most of the European countries need to focus on energy security, as well as carbon emissions, as well as price. So there's a three-legged stool there, that they have to have security and production, they have to have the right price, and they have to be able to reduce their emissions. And so we tick all those boxes for them, because we're literally a kilometre or two from the national grid. We're right near where most of the industry is in northern Italy. So we've got a very, very positive relationship with the current government. And whoever takes power going into the future, we think that we are able to work very, very closely with whoever's in power. But mostly it's the ministry that we work with, and we've got tremendous working relationships with the ministry in Italy.
Wonderful. And as you mentioned, you were continuing to advance other projects within the region with a 3D seismic campaign and multi-well drill program. So what's the expected timing to commence these programs?
Well, we're working on them right now. So we've commenced them already, but when the drilling takes place will depend on not only the local government, but the government in Rome and also the ministry. The ministry has actually approached us and asked if we can fast track some of these developments. So this has really meant that we can bring forward a number of things that we thought might take 2 to 3 to 4 years. We think that we'll be able to get them into place a lot more quickly than that. But there's always a lot of process that you've got to go through, a lot of bureaucracy. We're quite experienced in that area with our team, and we've got great relationships. But certainly we're looking at, while it's taking probably 18 months, 2 years to bring the other wells on stream. Once we bring them on stream, they're going to dramatically increase our revenues. But while we're doing this process, every month, if we have another $1 million per annum of revenue coming in from the existing well that's producing, it's going to mean that whatever capital raises we need to do down the track are going to be less than would necessarily have been the case if we had to raise that capital immediately. The other thing that we're investigating is other options, for example, paying for some of the capital expenditure by contracting to actually pay that on delivery of the well, and therefore it won't cost us a lot of money in dilutive capital raisings to try to do that. So we're looking at a number of different options at the moment.
Thank you, Kevin. Just another one that's popped up. You've described in detail the expected revenue, but not the expected costs to get the other rigs online. Is it your intention to use the cash or pay dividends?
At the moment, we're looking to use the cash. If I showed the actual chart there, and if people can go back to the chart in their own time, the cost of production is around about $700,000 or $800,000 a year for our 63% share. The cost of drilling that well was around about $8 million for the drilling and the connection with the pipeline and the installation plant. So that gives you a bit of an idea of the cost of drilling each of these lookalike wells. They might be a little bit less, a little bit more, but generally speaking, probably $8 or $9 or $10 million. We have a number of different options that we're exploring. We're doing all of the 3D seismic at the moment and going through the process of that. The cost of seismic has dropped quite dramatically because you no longer need wires going out across the fields. It's all done with internet connections and so forth. So that's going to help to reduce the cost there for the seismic work that we're doing. Once we've scoped the entire concession, we'll then be looking to drill in the most opportune way. And so we're doing those that work at the moment. And of course, once we've got that done, we'll be able to produce a lot more in revenue, and then we can be thinking about dividends. But my sense is that's probably going to be a couple of years away, because it's much better to use the shareholders' capital to increase the amount of dividends that will come down the track at the moment. So we're not going to be looking to pay our dividends and have to raise capital in 2 years' time.
Wonderful. Well, Kevin, thanks so much for the great presentation. If we have missed any of your questions, I would encourage you to reach out to Kevin directly via the contact details on their website. But thanks again for your time.
Good on you, Jane. Thanks very much. Thanks for having us on.